Pulse, the show where we break down the complex world of strategy consulting into digestible, actionable insights. And I'm Bhakti.
And I'm Akshay, a strategy consultant and blockchain enthusiast. Today, we are diving into a topic that's becoming impossible to ignore: tokenomics. Whether you are trying to invest in crypto projects or just trying to not sound lost among friends in the next house party, understanding tokenomics is quickly becoming table stakes.
Exactly. So today's episode is called Tokenomics for Dummies. Not because our listeners are dummies, but because tokenomics can feel like an arcane black box to consultants used to traditional business models. We are going to unpack it in plain English.
We'll cover what tokenomics is, why it matters, key components, real life examples, and how to approach tokenomic analysis from a strategy perspective. So let's dive into it.
Alright, let's start at the beginning. Akshat, how would you define tokenomics in one sentence?
Tokenomics is economic design of a crypto token, how it's created, distributed, used, and how it gains value within a blockchain ecosystem.
Nice. So think of it like a monetary policy of a startup. But instead of fiat currency issued by central bank, we are talking about digital tokens governed by code, smart contracts.
Exactly. It's not just how many tokens exist, it's about how they are allocated, how they are released over time, and how they are often used, and what incentives they create. It's the DNA of the entire ecosystem.
And for consultants, tokenomics is critical because it helps assess a project's economic sustainability and risk exposure. Bad tokenomics can tank a project even with strong product.
So let's break it down. There are five core elements of tokenomics that consultants should understand. First up, token supply.
Yes, and this includes three key metrics: maximum supply, how many tokens will ever exist; total supply, the number of minted so far; circulating supply, how many actively in the market.
Let's take Bitcoin. Max supply is capped at 21 million. Circulating is around 19.7 million. That scarcity drives value.
Then we have distribution and allocation. This is about who gets tokens when developers, investors, community, treasury.
Poor allocation can be a red flag. If 60% of tokens are in the hands of the founding team, there's a risk of prices crashing if they dump their holdings.
And that's where vesting schedules comes in. Linear vesting, milestone-based releases, and cliff periods all help align long-term incentives.
Third, utility. What is the token actually used for? Governance, staking, paying fees, accessing features.
If there is no real use case, it's just a speculative asset, and that's a problem. You want organic demand, not just hype.
Fourth, supply management mechanisms. Think burning, staking, buybacks. These influence scarcity and perceived value of the tokens.
For example, Binance burns BNB tokens quarterly based on trading volume. It's part of how they create value for holders.
And finally, tokenomic models. There are deflationary models like Bitcoins where supply tightens, inflationary models like Ethereum post merge where new tokens support ecosystem growth, and hybrid models, balancing the good in both the systems.
The key takeaway: no one size fits all. It depends on the use case and the community.
Now let's answer the question: why should a consultant care about all this?
Four big reasons. Economic viability: can the project fund itself, grow without collapsing its token value? Stakeholder alignment: are founders, users, and investors incentivized to collaborate, not compete? Third, risk mitigation: spotting issues like over centralization or unsustainable token emissions. Fourth, regulatory exposure: is the token a security? Does it comply with AML and tax frameworks?
We once worked with a client who built great healthcare app, but they allocated 40% of token to insiders and offered unsustainable staking rewards. Their token crashed within 6 months.
Exactly. They built a castle on quicksand. Good tokenomics is the foundation. Consultants can't afford to skip this.
Let's talk processes. When you are reviewing a client's token model, what's your playbook?
Step 1: Document review. Start with the white paper. Look for token allocation, use cases, emission schedules, and vesting.
Step 2. technical assessment, review smart contracts, are token burns or minting? Functions coded securely? Are there loopholes?
Step 3. Comparative benchmarking. Compare tokenomics to successful peers in the same sector. What industry standard?
Step 4. Financial modeling. Project future supply, simulate demand scenarios, model price volatility. This is where we apply our traditional strategy skills.
Step 5. Market dynamics. Look at liquidity, exchange listings, and user acquisition plans. No point in a great token model if no one trades or uses it.
Let's talk opportunity. Tokenomics consulting is becoming a standalone service. What can consultants really offer?
Several things. Design and development, build token models from scratch. Token audits, tokenomics audits, evaluate existing designs for risk and improvements. Regulatory compliance support, navigate SEC, FATF, and local law. Go to market strategy, help projects launch and scale sustainably.
It's a great value add. A solid token model boosts investor confidence and community engagement. We have seen clients have 10x their valuation post an audit.
Let's round out with common pitfalls to avoid.
Sure, first, over reliance on burning. Token burns can't substitute real utility.
Second, founder hoarding. Too much insider allocation kills decentralization.
Third, weak utility. No one wants a token with no use case.
Fourth, unsustainable rewards. Those 300% staking APYs that they don't last.
And fifth, poor vesting. If investor tokens unlock too early, expect a dump.
So, what are the best practices?
Transparent and equitable allocation, strong and real world utility, flexible supply management, vesting that aligns with the roadmap milestones, and ongoing tokenomic reviews as the ecosystem evolves around us.
Alright, we have covered a lot. Tokenomics isn't just a crypto jargon, it's the economic engine of Web3, and it's fast becoming part of consultants' toolkit.
Absolutely. So, whether you are advising a DAO, supporting a VC backed startup, or just trying to sound smart at a client dinner, understanding tokenomics helps you offer more strategic, future proof guidance.
Thanks for tuning into Larapulse. If you found this episode useful, share it with a colleague and don't forget to subscribe where you get your podcast.
Next week, we'll be diving into decentralized governance, what consultants need to know about DAOs. You don't want to miss.
Until then, stay curious, stay sharp, and keep unpacking.